This is Impact with Don Wenner. What's up, everybody? Producer Kyle here. Very excited to present this episode today. Don had the opportunity to sit down with Doug Bibby. Doug is the president of the National Multifamily Housing Council, NMHC for short. It's a national organization of more than 1,100 member firms involved in the multifamily housing industry. Under his leadership, NMHC represents the industry on Capitol Hill and before the regulatory agencies, promotes research and the exchange of information, and advocates for rental housing across a broad spectrum of issues. For the past 30 years, Doug has been active in the nonprofit community of Washington, D.C. He is a graduate of Denison University with a BA degree and was honored with the university's Alumni Citation Award in 2004. He also holds a Master's of Business Administration from the University of Texas. So let's dig into what this episode is about. There is an affordable housing crisis in this country, and it was here before COVID impacted our lives. And that crisis has just since worsened for so many reasons. So Don and Doug really dig deep into that critical issue and what are some of the solutions that we can bring to this crisis as a nation. Let's jump in to Don's conversation with Doug Bibby.
All right, so Doug, pleasure to have you here on the show today.
Thank you very much.
Well, what we're diving into here, Doug, is the affordability crisis we face in American housing. And I'd love you to just start off with kind of a broad question and ask you to kind of describe this affordability crisis and how you see it through your lens today.
Yeah, well, I think one of your staff asked me for what words would you describe the affordability crisis with, and I came up with three, which are frustrating, protracted, and complicated. And I can put them in a sentence, that it's a frustratingly protracted crisis that is complicated to navigate. And, there have been so many bright people, so many people with deep housing experience trying to solve the affordability challenges that we have. And, we seem to be slipping farther behind and not really making progress. And that's what's so frustrating about it. So frustrating is number one for me. And I cut my teeth in affordable housing at Fannie Mae in the 80s and 90s, and so it's a passion for me, and it's just enormously frustrating. I'll say it, no more than that.
So I know I read an article recently that you extended your retirement date out a few years, and is this frustration what decided you to keep working on this harder?
No, I wish I could tell you that's the case, but it's really more a function of how do you recruit a successor during a pandemic when your staff is 100% virtual. You're going to lose money because, like any other trade association, we rely on, on the meetings and so on to generate a lot of revenue. So we'll probably have a operating loss. So to bring somebody in with a virtual staff and an operating loss, it's just didn't feel so good. So they asked me to extend initially to 22, and then they asked me to stay. I will officially say goodbye in January 23, but thank you for asking.
Well, that makes great sense. So you led into it there well. Obviously, you mentioned this crisis has been going on way before the pandemic, but the pandemic has certainly, in some ways made the situation worse. And how do you see this pandemic affecting the affordability crisis and the government's response? How's that played out in your eyes?
Well, first of all, it has worsened. And if you take a look at the different dimensions that we look at, the supply is down, and while the demand is high, the occupancy rates for B and C properties are skyrocketing. But the supply is down. Construction costs are soaring right now, so it's hard enough to build ground up affordable, almost impossible anyway. But now it is impossible. You continue to lose stock. I think the only saving grace for properties that are owned by individuals or trusts or LLCs is that they're all wondering, well, do I want to sell now when I don't know what the tax situation is going to be that I'm going to face? And I think that's held some back. But we have lost stock, and as I said, so construction costs are up. But what the government did, and I don't always get to say this, I give them kudos for starting well over a year ago, back in March, with the CARES Act, provided direct financial assistance to people, and then the $600 a week in unemployment insurance benefits. That's $2,400 a month, and if you're in a B property or a C property, if you're paying $800 a month in rent, you just won the lottery. And that went all the way through July. And so that really helped us stabilize the market. I went into March thinking we're going to fall off a cliff. March of 2020, we're going to fall off a cliff. People are going to walk away from their rental, but everybody stayed in place and everybody paid their rent. It was remarkable. Then they had the two stimulus packages. One came out in December of last year, and then one came out this spring. And they provided the most unprecedented amount of assistance to the rental industry we've ever seen. Over $46 billion in the rental assistance program, the ERAP program, Emergency Rental Assistance Program. Those funds have been not exactly speeding out to the marketplace, but in certain markets like Florida and some other markets, they're doing quite well. California, I don't think has had one penny go out yet, but we're working very hard behind the scenes with all of the states to try to get this moving. So I give our policymakers, I give the administration, and I give Congress very high marks, for doing the right thing. This has really helped us tremendously.
Awesome. Well said. Speaking of, doing a great job and adapting to this environment, you and your team did a great job of rolling out this rent tracker, and it's been a great tool for everybody to kind of try to get a way to benchmark other than just calling our friends, right, and asking them how they're doing. So I'd love to understand, kind of how do you see the trends? What have they been telling you, and what do you think is going to happen ahead? As I know the moratoriums just got extended, but as these the additional $600 a week comes to an end and the moratoriums come to an end, how do you see this playing out or as a whole? And then I know certainly, as you've already alluded to, some markets are doing better than others in terms of their recovery. So what are the trends you're seeing?
Let me give you some of the things that we're seeing right now. Very late spring. The data providers were telling us, hey, people are leaving the downtown areas. The downtown area's been shut down for so long. There's nothing to do there. So they're moving back home with their parents, or they're doubling up, or they're just getting out of the downtown areas and going to the suburbs. And there was all the speculation, cities are dead, the downtown areas are dead. Well, come on. They said that after 9/11, the gateway cities, forget it, they're dead forever. You saw what happened. So the rents are rising in all markets right now, all markets. And that includes those that got hit the hardest, the San Franciscos, the Manhattans, the Bay Area, the Manhattan, and so on. So rents are rising. And there's now, though, a bifurcation that we didn't see before. Remember I said we had $600 a week coming in. So the people in B and C properties were golden. And then those operators also who were getting Section 8 funding, golden. But now at $300 a week, okay, that's $1,200 a month, okay? That's not the same thing. And so the stress we're beginning to see is showing itself a little bit more at the C level, C level apartments, and still the A's they're holding up quite well. So I think the markets are opening right now. Economies are coming back. I don't know what this Delta variant is going to do for us in certain markets, but it looks like it's going to be most pronounced in the lightest populated markets like Mississippi and Idaho and the Dakotas. And, I don't see this being as much of a problem in areas where we had significant vaccinations, I should say. So with the economy coming back, job creation moving forward, and with even the modest $300 a week coming in, I think that we're going to still experience a stable environment for a while, and then as the economy continues to progress, I think we're going to be fine. I do not. You didn't ask me this, but I will say I do not see some tsunami of evictions coming. And if you look at the math from the rent tracker, going back to that, 92 to 95% of residents were making full or partial payments every month through the entire existence of the rent tracker. And so you have a group of people, maybe 3 to 5%, who are what we call ghosts, who are just not paying their rent. They see this is a rent holiday, this eviction moratorium is a rent holiday. So, they're going to be evicted when the eviction moratorium is lifted. But as you know, you can't just evict people willy-nilly. You've got to go through a process of an eviction filing. You've got to go through the waiting protocols, and varies from state to state, as you know. And then you've got to go through a court system that has been closed for the better part of a year. And so I think, we're going to see a trickling out of eviction filings, and the physical displacements will take place downstream from that. But it's not going to be millions. If you just look at the math, it just doesn't play out. But there's fear mongering going out with the likes of Matthew Desmond and others that this is going to be this tsunami, and I do not buy that.
Well said, and the investor market would tend to agree with you. You'd say, based on the fact that property values are soaring, right, and cap rates have probably never been lower. It's unbelievable, and that's in almost all classes and much of the entire country. It's the demand for multifamily is very arguably never been better. So with so much money going into multifamily, and much of, especially the B and C class, but even some of the lower A class is often purchased with a value add strategy, right? And the simple plan being, we're going to come in here, we're going to invest more money into each unit, and in turn we're going to get higher rents. And that business model of coming in and driving rents up higher, of course, contributes to this affordability crisis. And so, how do you see the pros and cons and the overall perspective of this constant process of value add? And these properties go through 3, 4, 5 times of value add investment, just furthering taking the properties up in rent. How do you see that well-intentioned from an investment standpoint strategy affecting the overall affordability crisis?
Well, you're right. It has deepened it. I do think that one encouraging sign I see out there is, and I've seen this over my 20 years at the helm here, is a far greater understanding of the dynamics of multifamily housing. When I first came in, you had a 250 to 300 basis point risk premium over office and retail just to invest in multifamily. That has flipped, in certain cases. But it's just, there's a wall of capital coming, and including, I've had the great joy of being able to go overseas to markets like Israel and Australia and other markets in Mexico, and they're keenly interested in our affordable product. Moreover, in companies like Jonathan Rose, companies like Valueadd Capital Management, they have demonstrated very clearly to a very sophisticated investor basis that their operating model is very, very competitive and very compelling. And I think that the more folks like you and others, Morgan Properties, that invest in workforce housing, the more they look at your model, the better it looks. Because you have waiting lists of residents, you have very little turnover, and you have very, as I said, compelling statistics that investors can look to. So, as I said earlier, it's been a blessing in disguise is this uncertainty about taxes. Right. And so people are not they should be selling into an incredibly overheated, valuation market, but they're not. And I think it is because they don't know what's going to happen. And it changes almost every day. I was reading today about the latest tax proposals, and it's they're grasping for any straw they can get to try to placate the Republicans to try to get this through. And anyway, I share your concern, but I do think there's some silver linings out there.
So, the stats tend to be all over the place, but, one of the stats I read not too long ago was that about 500,000 units a year are coming out of the pool of affordability, as deemed by less than 30% of household income due to, a number of reasons, obviously being completely demolished and, something new built, but also, being, renovated or improved to the point that they're no longer affordable. So, and you can comment on that statistic, but overall, if we have, a number of good size and scaling real estate operators and developers and builders who listen into this podcast. And if they, like, DLP, want to focus on positively impacting this crisis while certainly generating profits for their investors, what would you encourage, us to do? What would be your thoughts? How do we be a part of the solution and not the problem here, while trying to still generate, positive returns to our investor base?
Yeah, I mean, I made this point when we, I don't know if you had a chance to see our housing affordability toolkit that we sent out about a couple of years ago.
Yep.
And I made the point then, and any discussions I have with the media, I make the point every time I can, is that policymakers at the state and local level are not only part of the solution, part of the problem for sure, but they're also part of the solution. And I think that it's going to be you guys working with municipalities in just identifying opportunities where they're going to have to make a difference. They're going to have to break down regulatory barriers. They're going to have to donate land. They're going to have to give tax abatement. They're going to have to open their toolbox all the way to help us produce more affordable housing. And when you look at I call it the hierarchy of development, and you start with the land.
Yep.
Okay, well, so what we are facing in so many markets still is exclusionary zoning, where we can't collate. Yeah, so if they take that land away from us, and we only can develop in really non-desirable areas where they don't want those poor people coming in apartments, then that really and plus the land has been bidded up in certain markets, as quite significantly. So if you have that land piece, that's number one. Then you've got the whole entitlement and regulatory processes to navigate, and this very, very well. They've got all kinds of barriers erected. You may have seen a study we did with the home builders on, up to 40% of the cost of development in the higher impact markets is the cost of regulation. So, that's where they've got to say, we will bring down these barriers, without sacrificing the safety and well-being of their citizens or anything to put people in jeopardy, but they've got to do that. The third and the biggest ticket item is the cost of construction. And as you know, when you build the bones of a building, whether it's luxury or at the very low end of the marketplace, it's pretty much the same. They're wired the same. They have windows, they have floors, they have, it's when you get to the finishes and you get to the higher end amenities, whether it's balconies or whatever it is, we have to drive that cost down. And again, that's an area where that's proved really, really intractable. We saw Katera go belly up. We've seen others in the modular business come and go. We just haven't had a breakthrough there. Don't tell me 3D printing is coming next week, because it's not. So you have that. And then you have the smallest piece, but it's still significant. And that's all of the debt and equity that has to go into to providing affordable housing. And that's where I have some hope too, that we can have certain types of investors on the equity side, but also on the debt side, who want to make impact investing. So it's a long-winded answer to your question, but try to figure out where we can make a difference. And I think, again, it's with you guys really extending an olive branch to the policymakers and saying, look, we want to work with you, but you have to work with us too, because otherwise, you just can't produce it ground up. And that's why your discussion of the appeal of value add today is why they can't build it. So, other than the LIHTC program, which provides maybe 90 to 100,000 units a year, that's it. There are others, Continental Properties, for example, does produce, vast of its majority of its units are at 80% of AMI. But they're the exception rather than the rule out there in terms of their ability to build affordable housing. So long-winded answer, I'm sorry, but it's a complicated, as I said earlier, it's complicated.
Well, very, very well said. And your comment about the importance of private and public, collaboration, something I know, and that you've been, proponent of and talking about for a long time. It seems like, at least in my eyes, this is the first time in a while that that the government is listening. And I know that's in large part due to the efforts of your organization. And so right now there's a bill out there. I know a lot of the details aren't fully clear. But a part of the infrastructure bill is to allocate billions of dollars to incentivize local policymakers to bend on these inclusionary zoning and work with developers and so forth. So talk to us a little bit about your thoughts on that. Do you think it's a step in the right direction? Do you any insights, perspective on it? You think it's going to go through? What are your perspectives on this?
Well, the Biden administration has said as recently as today that they have a deal, but there's two parts of the deal. One is the actual structure of the infrastructure plan, and the other is the pay-fors, which is what I alluded to earlier. That's where the rubber meets the road with real friction. We have been pushing and pushing and pushing for housing to be part of infrastructure. We have Chairwoman Waters of the House Financial Services Committee actually had a bill called Housing is Infrastructure. I thought that the original Biden proposal, which took into consideration the whole area of broadband, Wi-Fi, connectivity, is infrastructure. If that's not infrastructure in our world today, I don't know what is. It isn't just bridges and roads, it's data. And so I'm worried a little bit that they're pulling back and pulling back and pulling back. And it's gone from over 2 trillion to maybe 700 billion range. And so that's number one. I think it needs to go forward. It needs to happen. But the other piece of it is, I just don't know where they're going to end up on the tax side. And it's really hard to, as I said, it changes. It started with what I thought was the most elegant solution of all. Was what we should call a transactions tax, a couple of basis points on every transaction in real estate. And you think about the trillions that could create, it's not going to cause an affordability issue for anybody accessing debt for 2 basis points.
Sure.
But the hue and cry from the financial community, oh my God, the sky's falling, blah, blah, blah. So they pivoted here and then pivoted there. We're going to tax the rich, we're going to tax corporations, and it's just not clear, where it's going. We're having to just defend some of the high profile targets like the 1031 exchange and carried interest as 2 examples, because we feel that it will be deleterious to the economy to move away from the 1031 exchange benefits. And by the way, it benefits the agricultural community as much as it does real estate.
Well said. So I want to kind of tie into the financial community. So, I think what gets more attention and conversation in the real estate market today is home prices, and I think that's thing that is most talked about and surprising and astounding to a lot of people is how quickly home prices have gone up, and there's a lot of talk about how can people afford these higher home prices, but the reality is in a lot of the country, because interest rates have remained so low, that the cost of home ownership in terms of how most people think about it, your monthly payment, really has not gone up significantly. And there's lots of ways you could look at it, that it's more cost effective to own a home today at any point in the last 20 years, despite that we've seen 15, 20, 25% increase in home prices in the past year in many parts of the country. Right now, in many parts of the country, it is more cost effective on a monthly basis to own a home than to rent an apartment, and especially in A communities. But as soon as interest rates were to go up, to 5% or 6%, the affordability of homeownership is gonna decline tremendously, which in my eyes will increase the demand even further for rentership, which we already, as you and I and probably everybody listening know, there's not enough supply. So how do you see interest rates as a whole in that context, or in any other? How do you see, whenever it does happen, the effect on interest rates?
You want to hear from the guy who's been wrong on cap rates for 10 consecutive years? You really do?
Yes.
I will say that the affordability crisis extends over to single family because there are no starter homes being built. And again, it's the issue of the cost to produce the product and the regulatory barriers and the actual cost of construction to get there. So they're having to increase their price point to such a level that the younger folks are being bid out of the system. And then you have a whole big cascading effect of, I was just talking to somebody last night who didn't even put their house on the market. Someone came in with 25% over the market, bid, and that was, gone. My sister lives in Palo Alto. She has a tiny two-bedroom house with a little postage stamp yard. The realtor came by and said it will go for $3.5 million. Now you put that house in Des Moines or in Vermont or in Mississippi, it will go for $250 maybe, $3.5 million. It is so out of whack right now with pricing that we've got to break it. We've got to break it somehow and find a way to produce more starter housing. That's really important, for the housing market itself.
Yeah, well said.
I can't tell you where interest rates are going, except I have an instinct, which is probably wrong, that there's going to be upward pressure on them as the economy begins to strengthen. And a lot of people are prognosticating that will be the case, but will they inch up or will they go up in a significant way? I couldn't tell you.
So on that, topic of not building enough starter homes, one of the unique trends, I guess, over the last couple of years, you'd say, is this build to rent new investment class, and it's the hottest class out there, arguably today. It's getting a lot of talk. It's still a very small amount of the market, rental market, comparatively to multifamily. But how do you see this big push and focus on build to rent single family communities? How do you see that affecting the multifamily industry and the overall, housing shortage that we have in America today?
I'm torn on that one because I do believe that it just further reinforces that renting by choice is the norm now rather than the exception. But I think you're right. It is the hottest thing right now. You have Lennar and others. Home builders, traditional home builders have set up divisions. And some of my members have also begun to dip their toe in that water. And some of them are using local home builders who have access to land and have entitlements that they don't have to go through any process. If they're building them where they have access to schools, jobs, and so on, I think it will be meaningful. If they don't, and they're putting them in cornfields because they can get that land, I think it will fail. But I do think that what the pandemic showed is that people are okay with renting, but when they have a big family or they want to be near schools, they want to make sure that they have more space and access to those benefits in the community. We're watching it very carefully. We had a panel at our annual meeting, San Diego, on that. So we'll probably have another one in January at the annual meeting. So it's real.
Excellent, thank you. So last main question here, and then I'm going to kind of open up a little bit to you. Is I've coming into multifamily industry, I've always found it, I guess the best word I can think of is strange. That I guess I could just stop there, just the market strange and the industry as a whole. But more specifically, I find it strange that the industry finds it normal, and we've chosen to have 1-year leases. That's what everybody does, and that's the industry norm. And then we renew for 1 year, and that it's normal to have 40% of residents not renew every year and move somewhere else. And in my opinion, the constant moving of residents and paying for moving costs and deposits and so forth is one of the biggest strains on a lot of working families. So I'm just curious, is why do you think that's how everybody operates and that's the norm? And what's your perspective on just, how the relationships between residents and owners should be moving forward?
I think you'll see, I mentioned a couple of companies where they don't have that turnover. Actually, turnover's been down, as you know, for a couple of years. When I first took over, the reason that multifamily was given such a risk premium was the investors were saying, well, you have to reprice your assets every year.
Right.
And I said, yes. And they're going up, and they typically get repriced this way, up. And they began to say, oh, well, that's not so bad. I think people got into the mindset of, I don't really care as much about the turnover because I'll be able to reprice that asset higher,
right,
in a marketplace, in a normal marketplace. But I'm with you. I mean, I think I would love to see longer term leases, more of a partnership with your residents. We're seeing it with Jonathan Rowe's company. We're seeing it with Valueadd Capital Management. We're seeing it with other companies. So that's another one that frustrates me from time to time, because I came in saying, well, why don't we try this? Why don't we try that? It just got, was a mainstream of I don't really care because I can reprice and I'll move. I can convert that apartment quickly to a higher rent. So I think it's a little bit short-sighted.
Awesome. Yeah, great feedback. All right, so just to wrap us up here, we have a mix of listeners here to the podcast, but the kind of couple camps that our listeners fall into are real estate operators growing a business, either developing and building brand new or doing value add, both multifamily and single family, and then we have families, high net wealth creators wanting to invest in this asset class, and many of which who really do want to make an impact. So knowing who our listener base is, what are your any final kind of takeaway or point or anything you'd like to share related to this affordability crisis here with our listeners today?
Well, I do believe that both international capital and domestic capital are interested in the challenge, and they are now more enlightened than they've ever been about the competitive returns in the business. So it isn't, you don't have to go out and do the highest end market rate product to perform well in the marketplace. And to your earlier point, you can have a pretty consistent base of residents. The fact that they have waiting lists to get into some of the company's units that I talked about means that they have very little turnover going on there. They do a lot of things to cultivate their residents. They bring in medical services, screening, they have after school programs. They have police. One of them has a police office in the apartment community, and all ways to reassure that population that they're being cared for in non-traditional ways. So I think investing in the affordable side of this business will provide great benefits to the investors themselves, but also provide great sense of satisfaction to those who are redeveloping or even, God bless them, developing affordable product.
Well said, Doug. Truly been a pleasure. Thank you so much for your time here. A number of nuggets and takeaways, I believe, for many of us. So thank you so much. Been an honor.
Been my pleasure, Don. Thank you very much. Be well.
This has been Don Wenner on the Impact Podcast. Thank you so much for joining us on this episode. You can check out our other episodes by subscribing wherever you get your podcasts or on YouTube, or check us out online by going to impactwithdon.com. I encourage and challenge you to make an impact.